How do EMI and SIP impact your long-term financial planning? Welcome back to Plan Future AI Insight. I am your Investment DADA, and today we are tackling a fundamental tug-of-war in personal finance, the impact of EMI versus SIP in your financial planning. What a thoughtful question. It is brilliant that you're thinking about how these two monthly commitments balance out in your financial life. Let me break this down for you, simply and clearly. Bar graph the core difference, debt versus wealth creation. Think of an EMI as a debt payment. You are paying back someone else for a comfort you enjoyed in the past. A SIP, on the other hand, is an investment. You are paying yourself first to secure your future. Both are powerful monthly commitments, but they pull your finances in opposite directions. Imagine your financial life as a bucket with two holes. One lets water out, which is your EMI, and one lets water in, which is your SIP. Your ultimate goal is to make sure the inflow comfortably beats the outflow. Numbers. Let's look at the math. To understand the real impact, let's compare two different scenarios. Scenario A, high EMI, low SIP. Say you take a 50 lakh rupees home loan at an 8.5% interest rate for 20 years. Your monthly EMI comes out to roughly 43,391 rupees. Over 20 years, your total interest paid shoots up to 54.14 lakh rupees, meaning you actually pay more in interest than the principal amount you borrowed. If this heavy EMI forces you to only spare 5,000 rupees a month for a SIP, that investment growing at a 12% average annual return will reach about 49.7 lakh rupees after 20 years. Look at the net result. Your debt cost you over 54 lakh rupees in interest, while your wealth only grew to 49.7 lakh rupees. You are running behind. Scenario B, balanced EMI, strong SIP. Now, imagine the exact same home loan, but you decide to skip taking an additional car loan, saving you an extra 20,000 rupees a month in EMI. Instead, you divert that 20,000 rupees straight into a monthly SIP. Over those same 20 years at a 12% return, that extra SIP grows into a massive 1.99 crore rupees. Suddenly, that 54 lakh rupees of home loan interest is completely dwarfed by the wealth you've created. You successfully used a loan to build a real estate asset, while compounding built you a fortune. Light bulb DADA's framework, the 40% rule. From 20 years of watching households succeed or struggle, I have developed a golden rule for managing this balance. Your total monthly EMIs should absolutely not exceed 40% of your take-home income. Below 30%, excellent. You have plenty of breathing room for aggressive SIPs. 30% to 40%, manageable. A disciplined SIP plan is still highly achievable. 40% to 50%, caution. Your investment capacity is being heavily squeezed. Above 50%, this is the danger zone. You must prioritize debt reduction before you focus on aggressive investing. Crystal ball navigating market realities. When interest rates are high, floating rate EMIs naturally increase. If you have a home loan, it is wise to keep a prepayment buffer of 3 to 6 EMIs in a liquid fund to absorb rate hikes. Crucially, remember that SIPs become incredibly powerful during volatile times. Do not pause your investments when the market dips. While your EMI stays completely fixed, a volatile market allows your SIP to buy more fund units at a lower price. When the market recovers, those extra units accelerate your wealth creation. Bullseye your action steps. Step 1. Calculate your EMI to income ratio this week. Add up every single EMI, home, car, personal, and credit cards, and divide it by your take-home pay. If you are above 40%, target your highest interest debt for immediate prepayment. Step 2. Set up an auto SIP in a stable, balanced fund category. The amount doesn't matter initially, even 1,000 rupees a month works. Building the habit of paying yourself first is what counts. Step 3. Build a debt shield by keeping 6 months' worth of EMIs in a safe, liquid asset. This ensures that even if your income faces a temporary disruption, your credit score stays perfect and your long-term SIPs never break. Glowing star Dada wisdom of the day. Greater than, the EMI buys you comfort today. The SIP buys you freedom tomorrow. A person who balances both doesn't just survive, they thrive. The best time to start a SIP was 10 years ago, but the second best time is today. Even with a small amount, start building the habit. I am genuinely proud of you for asking these structural questions. Most people focus entirely on what they owe, rather than what they own. You are already thinking ahead. Remember, investment in the equity market is subject to market risk. Past performance is not indicative of future results. This is Investment DADA, signing off. Stay wise, stay invested, and build your future with confidence. Thanks and regards, Cost of Bishwas from Plan Future. Please visit our website at www.planfuture.in for your data-driven investment analysis.